Imagine building like an artificial intelligence engine that's so incredibly smart, it can evaluate thousands of complex data points to predict the financial future of millions of people.
Right, the ultimate financial brain.
Exactly. But then you watch it get completely derailed because someone found a crisp $100 tax refund in the pocket of their winter coat.
It's such a funny visual, but yeah, that's exactly what happened.
It really is. Well, welcome to the deep dive. Today, our mission is to decode the actual mechanics of a modern AI-driven financial company when it collides with the messy, unpredictable reality of human behavior.
Because humans are definitely messy.
Oh, absolutely. So we are looking exclusively at the Q1 2026 earnings call for Upstart, and we're specifically focusing on the debut of their new Chief Financial Officer, Andrea Blankmeer.
Yeah, her first time up to the mic for them.
Right. And we are going to bypass the dense spreadsheet jargon, and figure out how an AI credit platform attempts to balance this really aggressive, relentless expansion into brand new markets with the cold, hard reality of capital efficiency.
And that balance it's the ultimate tightrope walk for any major tech platform today. We aren't just analyzing how much revenue Upstart generated this quarter.
Right, it's bigger than that.
Exactly. The stakes here are structural. It is about the fundamental tension between spending a fortune to teach an algorithm how to conquer new sectors of the economy while simultaneously proving to the market that your underlying business model can, actually turn a real profit.
Okay, let's unpack this, because to truly understand a financial report of this magnitude, you can't just read it like a math textbook.
No, not at all.
You have to read it like a strategic playbook. And instead of leading with the top-line revenue, we really need to start with the architect behind the numbers.
Andrea Blankmeer.
Yes. When Blankmeer steps up to the mic for her very first earnings call, she doesn't just list off statistics. She immediately establishes like a philosophical baseline.
Yeah, she sets the tone right away.
She tells the market that she treats equity as a real, tangible cost, and that her absolute priority is a capital-efficient business.
And what's fascinating here is that statement is a highly calibrated signal to institutional investors. By declaring that equity is a real cost, she is assuring the market that she isn't treating the company's shares like monopoly money.
Which happens a lot in tech, right?
Oh, constantly. In the tech sector, it is incredibly common for companies to dilute their own stock by casually handing it out to fund endless, unprofitable growth. But she is planting her flag as a strict financial steward.
Setting a boundary.
Exactly. She and the CEO are broadcasting a promise of severe financial discipline. But, well, as we see in the very first quarter of the year, that discipline is immediately put to the test by seasonal realities.
It gets tested incredibly fast because right out of the gate, we get this massive reality check regarding the first quarter. I mean, normally you would think the start of a new year means fresh starts, new projects, a surge in consumer borrowing.
You'd assume so, yeah.
But Blankmeer reveals this really specific constraint. Consumer demand for personal loans at the very top of the digital funnel actually drops significantly in Q1.
It feels entirely counterintuitive until you map it against the calendar.
Which brings us back to that $100 bill in the winter coat.
Yeah.
The tax refund phenomenon.
Right. Tax season.
For millions of consumers, the first quarter of the year brings a sudden, sometimes really substantial cash infusion straight from the government. And temporarily, that unexpected liquidity completely evaporates their urgency to go out and borrow money.
It completely changes their behavior.
It does. But I want to understand the mechanics of this. How does someone deciding not to get a loan actually hurt a platform that uses AI to filter out risk? Like, why is that a problem?
It all comes down to the mechanics of the digital funnel and borrower acquisition. So Upstart spends marketing dollars to get potential borrowers to visit their platform.
Okay.
If a user arrives, starts the process, but then realizes their tax refund just hit the bank account, they abandon the application.
Oh,
Right. So the marketing money to get them there has already been spent, but the loan never crosses the finish line. Because consumers don't need loans as badly in Q1, the conversion rates at the top of the funnel just plummets.
that makes total sense.
Yeah, you are paying the same fixed costs to keep the servers running and the algorithms calculating, but fewer completed transactions are generating fee revenue. And that inherently drags down the company's contribution margin compared to the fourth quarter.
And it isn't just external consumer behavior putting pressure on the margins in the first quarter either.
Yeah.
There's the deeply internal human mechanism that kicks in as well, which Blankmeer was surprisingly transparent about.
Yeah, the operational expenses, the OPEX.
Right. She notes that Q1 comes with a specific, unavoidable spike in internal costs. You have the annual compensation and benefits cycles resetting.
Bonuses paying out, yeah.
Exactly. And you have the massive corporate costs associated with flying talent in for their annual all-hands meeting. It is a stark reminder that while artificial intelligence might be the product making the lightning-fast credit decisions, incredibly expensive humans are the ones building and maintaining that AI.
And that is a crucial dynamic to grasp. Retaining elite data scientists and engineers in 2026 requires aggressive compensation packages and strong corporate culture investments, like an all-hands summit.
Can't skip on that.
No, you really can't. Furthermore, Blankmeer noted they made deliberate, heavy investments in hiring fresh talent, specifically during Q1, to prepare for their ambitious goals for the rest of the year. They are essentially absorbing the pain of these fixed human costs upfront.
So Q1 operates like a pressure cooker. External loan demand is artificially depressed because consumers are flush with tax refund cash. And internal costs are artificially high because the company is paying out bonuses, hosting global meetings, and hoarding tech talent.
It's the perfect storm.
It really is.
Yeah.
Under those incredibly heavy headwinds, you would assume the platform's volume would stall out entirely. But then you look at the actual performance data, and the numbers are staggering.
They really are.
They pushed out $3.4 billion in loan originations. That is a massive 61% jump year over year. And total revenue came in at about $300 million.
The sheer volume of money moving through the system is just immense. But the total dollar amount isn't the real story here.
No.
Not at all. The strategy is hidden entirely within the composition of that $3.4 billion.
Let's break down that mix then, because they are fundamentally mutating beyond their original identity. Overall personal loan originations grew by 6% from the previous quarter.
Right.
But within that category, super prime personal loans, meaning loans, extended to the absolute most creditworthy low-risk borrowers, shot up 26% quarter over quarter.
A huge jump.
Huge. And then, when you look completely outside of personal loans, the shift is even more dramatic. Auto originations jumped 32%, and home loan originations grew by 16%.
What we are witnessing is a massive diversification play away from unsecured risk.
Explain that difference for us.
Sure. So a standard personal loan is unsecured. If the borrower defaults, the lender takes a total loss. There's no collateral.
Right.
But auto and home loans are secured by tangible assets, a car or a piece of real estate. By aggressively pivoting their AI models into auto and home lending, they are building a much more resilient, fortified foundation.
But wait, I need to stop you there and push back on this, because this is where the financial narrative gets highly contradictory.
Okay, let's hear it.
I'm looking at these massive growth percentages. They pushed out $3.4 billion in loans. They are breaking into the massive auto and home markets. But then I look at the actual bottom line, and the margins dropped to 50%.
Yes, they did.
And more importantly, they posted a net loss of $7 million for the quarter. That translates to a negative 7 cents GAAP earnings per share.
Which sounds terrible on paper.
Exactly. In any traditional financial institution, posting a net loss alongside record origination volume is a massive red flag. It usually implies your underwriting is failing and you are just buying top-line growth with bad loans, like a sugar rush for the platform. Are you telling me Blankmeer is pitching this net loss as a feature, not a bug?
That is the exact friction point that terrifies casual investors. But you have to look at the mechanics of how a tech company scales into heavily regulated traditional markets like auto and home lending.
Okay, walk me through it.
To answer your question, yes, Blankmeer is framing this as a highly calculated feature of their 2026 strategy. The drop in the contribution margin to 50% was not an accident of bad underwriting. It was a deliberate, strategic choice regarding unit economics.
Explain how losing money intentionally works in their favor here.
Well, Upstart is intentionally front-loading their fixed cost investments and their marketing spend to build the digital infrastructure for these new channels.
Because it's a whole new market for them.
Exactly. Traditional banks evaluate auto and home loans using archaic, rigid metrics like a standard FICO score or basic debt-to-income ratios. Upstart's AI evaluates thousands of alternative data points to price risk differently, finding good borrowers that traditional banks reject.
Right, that's their whole edge.
Yes. But to acquire those specific borrowers, you have to build entirely new digital funnels. You have to integrate your software with local car dealerships. You have to navigate complex, localized real estate regulations.
Which requires an immense amount of upfront cash to build out.
Exactly. Variable costs for borrower acquisition and servicing jumped 68% year over year. That entirely reflects this aggressive marketing and integration push. They are absorbing the colossal cost of building the highway right now so that the tolls they collect later are pure profit.
Ah, I see.
And Blankmeer was incredibly firm on this point. Assuming the broader economic environment remains stable, that 50% contribution margin we saw under the weight of Q1 should act as the absolute floor light, the lowest point of efficiency for the entire year.
Let's follow the money on this, though. Because if they are intentionally squeezing their own margins, hiring expensive talent, and spending heavily on marketing to build these new auto and home funnels, they are burning through their own cash reserves rapidly.
Very rapidly.
So where is the actual capital coming from to fund $3.4 billion worth of loans?
Yeah.
They certainly don't have that kind of liquidity just sitting in a corporate checking account.
And that quote exposes the brilliant hidden engine of the entire Upstart business model. They are not a traditional bank taking in deposits from everyday citizens and lending that same money back out.
Which blew my mind when I looked at the balance sheet metrics Blankmeer revealed. Out of that, $3.4 billion in loans originated just in Q1. Upstart only holds slightly over $1 billion in loans on its own books.
A tiny fraction.
Right. And that internal balance sheet number only went up by a mere $30 million from the fourth quarter.
Despite supercharging their loan origination volume to record highs, they're barely touching their own capital to actually fund the loans.
So they aren't acting like a bank vault at all. They are operating more like an incredibly high-speed, highly intelligent matchmaker.
That's a perfect analogy.
They use their AI to evaluate the borrower, price the risk, connect that borrower with someone else's giant pile of money, take a fee for making the connection, and then completely step out of the way.
That is the exact mechanism. The true lifeblood of the platform is third-party capital. They rely on an expansive ecosystem of institutional partners.
So big banks and funds.
Right. Blankmeer noted that so far this year, they have secured over $4 billion in committed capital partnerships. That means massive financial institutions are looking at Upstart's AI models and deciding that the algorithm is so accurate at predicting default rates that they're willing to blindly commit billions of dollars to fund whatever loans the AI approves.
That is a staggering level of trust in an algorithm. But it isn't just direct partner banks handing over cash, is it? The report highlighted that they executed 2 asset-backed securitizations, or ABS, totaling another $1 billion.
Yes, the ABS market is huge for them.
For the listener who doesn't spend their weekends reading Wall Street derivative structures, how does an ABS actually function here?
Okay, think of Upstart like a high-end talent scout in professional sports. Upstart doesn't actually have the billionaire owner's money to pay the athletes massive salaries. They just use their incredibly advanced scouting AI to spot the hidden talent.
The good borrowers who might be overlooked by traditional metrics.
Precisely. They draft thousands of these borrowers, bundle all their loan contracts together into one massive package, and immediately trade that package to massive institutional investors like pension funds or insurance companies for a lucrative finder's fee. That is an asset-backed securitization.
It's essentially a risk transfer machine. They use their specialized tech to originate the loans, but by bundling and selling them off to institutions that desperately need a return on their investments but lack the AI to find the borrowers themselves, Upstart instantly clears the risk off their own balance sheet.
Right, they pass the baton.
They free up their cash and prepare to do it all over again.
It allows a nimble tech company to process the gargantuan volume of a legacy bank without carrying the catastrophic systemic risk of actually holding all those loans if the economy suddenly turns sour.
And speaking of how they utilize their capital, there is one specific move they made in February that feels like the ultimate missing puzzle piece.
The share buybacks.
Yes. Blankmeer casually mentioned that Upstart took $100 million of their own corporate cash and used it to buy back 3.2 million shares of their own stock on the open market. Plus, they still have another $122 million authorized to do it again.
It's a huge flex.
It is. If you're looking at this stock, why on earth would a company take $100 million in cash and buy its own shares when it is ostensibly trying to fund an aggressive expansion into the home and auto sectors?
Because it is the ultimate, undeniable signal of leadership's confidence in their own internal forecasts. Remember Blankmeer's core philosophy from the beginning? She treats equity as a real cost.
Right, no monopoly money.
Exactly. When management looks at the public market price of their stock and decides the most capital-efficient use of $100 million is to buy their own shares, they are sending a glaring message to the market.
They're betting on themselves.
They are essentially saying, we believe Wall Street is fundamentally mispricing our technology. The best investment we can possibly make right now is betting on ourselves. By removing those 3.2 million shares from circulation, it theoretically makes every remaining share more valuable, and it telegraphs immense confidence that their underlying cash flow is incredibly strong.
They are quite literally putting their money where their AI is. So if we pull all of these complex threads together, the seasonal headwind of the tax refunds, the deliberate margin squeeze to pay for new auto and home infrastructure, and this massive risk-transferring capital engine humming in the background, does the math actually prove out their strategy for the remainder of 2026?
According to the specific reaffirmed guidance Blankmeer laid out, the math works out exceptionally well, but the timeline of profitability is going to be heavily skewed.
She laid out the finish line targets for the entire 2026 fiscal year. They are projecting $1.4 billion in total revenue. Within that, $1.3 billion will be purely fee revenue.
That is the matchmaking fee we discussed.
Exactly. And most importantly, they are targeting $294 million in adjusted EBITDA. Let's make sure we are crystal clear on what that means. When they report a $7 million GAAP net loss, the headlines scream that they are bleeding money. But then they tout this adjusted EBITDA number.
Right, and to understand the difference, you really have to strip away the theoretical accounting layers. GAAP, which stands for Generally Accepted Accounting Principles, is the strict regulatory way of reporting profit.
The official rulebook.
Right. It forces a company to count things like stock-based compensation given to employees as an immediate expense, even though no actual cash left the company's bank account. Adjusted EBITDA removes those non-cash accounting theories. It is a metric designed to show you the actual real-world dollars generated by the core business operations. It's their way of saying, if we only look at the physical money coming in from fees and the actual cash going out to run the servers and pay the staff, this engine is generating nearly $300 million in profit.
So how do they mathematically jump from a first quarter loss to a massive $294 million profit by the end of the year? That's a huge leap.
It entirely comes down to the leverage created by front-loading their expenses. Because they took their medicine early, absorbing the massive marketing costs, the tech integrations, the corporate bonuses, all in Q1, those operational costs will dramatically moderate for the rest of the year.
Because they've already been paid for.
Yes.
Yeah.
Furthermore, as the auto and home digital funnels mature, the unit economics of each individual loan will improve. They project that absolute contribution profit dollar growth will stay within a tight 5 percentage points of fee revenue growth.
Which means the heavy lifting is completely done. As revenue scales up over the summer and fall, the profit scales up in almost perfect lockstep because the infrastructure is already built and paid for.
Precisely. Because of that baked-in efficiency, Blankmeer made it very clear that the bulk of that $294 million in adjusted EBITDA will be heavily concentrated in the third and fourth quarters of the year.
So what does this actually mean for you as you evaluate this company? When you look past the dense earnings jargon, Upstart is clearly executing a very long, very deliberate game.
A very patient game, yeah.
They are actively choosing to sacrifice their short-term first quarter margins in exchange for building a fortified, highly diversified credit platform. They are no longer just a risky personal loan company. They are embedding their highly trained AI directly into the deeply lucrative auto and home markets, and they are using billions of dollars of institutional third-party money to do it.
It's brilliant.
It is a masterclass in risk transfer and capital efficiency, exactly as their new CFO promised on day one.
It is an incredibly sophisticated, meticulously designed machine. However, there is one vital piece of this puzzle that cannot be ignored.
Huh?
Blankmeer placed a single overarching caveat on all of these optimistic projections. She stated explicitly that this entire $1.4 billion revenue trajectory assumes a stable macroeconomic background.
The ultimate unknown variable.
And this is the concept that is truly worth contemplating. We spent a significant portion of this deep dive analyzing how a completely predictable, routine annual event, everyday citizens receiving a standard tax refund, was enough to structurally shock their digital funnel, alter consumer behavior, and visibly compress their first quarter margins.
Just a slight temporary change in consumer liquidity totally shifted the math of their AI's acquisition model.
Right. So if a highly anticipated historical norm like tax season can cause a visible disruption to the performance of this machine, how vulnerable is this highly tuned historical data-dependent AI model if the broader global economy suddenly experiences an unprecedented shock?
That's a really good point.
If an artificial intelligence engine reacts this dramatically to a seasonal bump in the road that it saw coming from a mile away, what exactly happens when it hits an economic pothole that isn't on the map?